In today's episode, we'll break down one interesting story in depth, followed by a shorter story. First, we'll talk about SEBI finding fraud in the cloud, and then we'll talk about an unseen fallout of insurance commission caps. Welcome back to the Daily Brief by Zerodha, where we cut through the noise to help you understand what's actually happening in the most important stories from business and markets. I'm your host Akshara. Today is Thursday, 27th August. Coming to the first story. Every industrial revolution, from the first car to the first robot, may be different in product characteristics, but has some uncanny similarities. When a new technology shows commercial potential, entrepreneurs rush in and fuel tons of money in the hope that one day they'll reap outsized returns. But this creates a frenzy where too much money ends up chasing far fewer returns. Eventually, this bubble bursts and causes a recession. But with the right policies, such a recession gives way to a golden age of productivity. Now, in the chaos of a bubble which is fueled by easily accessible capital, there will almost certainly be bad actors. They may rely on the shine of this new technology to manipulate markets without actually advancing it, and they may even resort to blatant fraud. So, in the age of a massive data center build out, we are already seeing signs of this in India. In 2022-23, a company called Varanium Cloud, led by promoter Harshvardhan Sabale, raised money from the public markets, and it made many promises on the back of data centers and cloud services. But on Monday, SEBI published a 155-page final order which found nothing but smoke and mirrors instead and accused it of outright fraud. So the story starts from Varanium's listing. In its prospectus, Varanium said to investors that it would use the proceeds of its rupees 40 crore IPO in three things. First, it would build 3 edge data centers, which are small data center units that are meant to serve only the devices close to it. Second, Varanium would set up 3 digital learning centers. And third, it would run a BPO operation out of these locations. Between listing and the interim order in May 2024, Varanium made 25 corporate announcements, and here are some of the big ones. So, Varanium was meant to inaugurate an edge data center in Goa, and it announced a partnership with Secure Credentials for BPO operations. It also launched a cloud-based medical wearable device. It disclosed plans to acquire a cable company for rupees 2,683 crore to be paid wholly in cash. And it told the stock exchanges it was setting up a data center in Malta and separately that it was planning to list a subsidiary on the Nasdaq. None of these announcements materialized. But yet, SEBI found that 11 of the 25 announcements moved the stock price upward, including 2 that triggered upper circuits. So how do we know what was real and what was up in the clouds? In January 2025, SEBI and NSE conducted site visits at every location Varanium claimed to operate from, and it found many damning facts. To start with, at the given Goa address, there was no edge data center building, which Varanium told investors it had commissioned in December 2022. Instead, a Varanium admin office was found, whose staff had no idea of any edge data center plans. The lease for the premises was dated April 2023. 4 months after the supposed commissioning. And then there was the electricity bill. Even the most unknowing person is aware that data centers are among the most power-hungry facilities in existence. But a single monthly billing cycle towards the end of 2023 showed just 6 units consumed. That's what a light bulb uses in a few days. And that's weird for a data center that's been in commission for a whole year. What's more, in the immediate next month, the electricity bill jumped to a whopping 2,450 units. Possibly, someone had switched things when the laws long had reached them. At another location in Savantwadi, Varanium had publicly announced it employed over 125 young people in its BPO. But SEBI only found 8 people who said that they were only involved in documentation work. They were doing very little of what a BPO does. Now, the vendor who was meant to build all of this was Avance Technologies, which is also a publicly listed company. But somehow it had 0 fixed assets on its balance sheet. Avance later confirmed to SEBI that it didn't execute any work because Varanium chose to handle the projects directly. The quotation Varanium obtained from Avance for the IPO prospectus exceeded Avance's own annual revenue. Now, if the operations were fiction, the financial statements were a masterpiece of the firm. Over FY23 and the first half of FY24, SEBI found that most of Varanium's reported sales and purchases were fictitious. And the centerpiece was Amtelphone, an entity Varanium claimed to sell services to. Over 2 years, Varanium booked rupees 594 crore in sales to Amtelphone, and a public domain search yielded only basic information about the company. Neither Varanium nor its suppliers could furnish any invoices or contracts in support of the transactions. So when SEBI examined Varanium's tally ledger, the entries for Amtelphone were monthly lump sums recorded at the end of each month, but without corresponding bank receipts. Instead, Varanium's journal entries offset Amtelphone's receivables against payables to Amazon Web Services. Now, Varanium claimed to have purchased rupees 444 crore in cloud services from AWS. But when SEBI asked, AWS sent back invoices that merely amounted to rupees 20,000 to rupees 23,000. Now, Varanium's books also contained a single journal entry of rupees 107 crore worth of sales to a US based clothing company called Courage Clothing. For one, this company had nothing to do with cloud services. But secondly, no receipts existed as evidence of this transaction. So, all of this should tell you enough about the quality of Varanium's accounting. And then there were sales to entities owned by the same promoter, all of which followed the same pattern. Three such promoter group entities each had two sales entries booked at quarter end with token amounts of rupees 5 lakh moving through the bank account to create the appearance of a transaction. And few of these transactions were also not disclosed as related party transactions. While the books showed hundreds of crores in fictitious transactions, the actual money raised from investors took a much simpler path. Of the rupees 40 crore raised through the IPO, rupees 19 crore was transferred to BM traders and three promoter-owned entities, Turmeric Lifestyle, Varanium Earth, and Varanium Lifestyle. Now, beyond having a common promoter, Varanium had no disclosed business relationship with any of these entities. And the IPO prospectus certainly didn't envision transferring money to them. Now, post IPO, Varanium raised rupees 48 crore more through a rights issue. Shockingly, 90% of it went to Harshvardhan Savale's personal bank account and promoter group entities. Meanwhile, Savale was selling his shares. The stock had opened at rupees 131 on listing day and, aided by the stream of corporate announcements, rose to over rupees 1,500 by January 2023. Between November 2022 and March 2024, promoter entities sold shares worth rupees 149 crore. And after accounting for acquisition costs, SEBI calculated the unlawful gains at rupees 129 crore. By May 2024, when SEBI issued its interim order, the stock had collapsed to under rupees 18. Now, a board that existed only on paper rounded out the picture. The CFO didn't even have experience in finance and was a network engineer by profession. As CFO, he didn't work on anything finance related and only stuck to the technical stuff he knew. So, all of these board members testified to the same fact. Harshvardhan Sabale had immense amounts of control on the money lever. Now, based on these findings, SEBI gave the promoter and some of the other accused folks a show cause notice. And in response, Sabale came up with a 235-page defense, but SEBI found it very easy to dismiss all of it. So, the reason for that is the most entertaining part of the whole ordeal. After all, it was found to have been full of AI hallucinations. The evidence used to back up the defense either didn't exist or was used completely out of context. For instance, Savale said that as per the judgment of the now infamous Ketan Parekh case, proving fraud requires showing the existence of five specific elements. But the judgment itself was untraceable at the given citation. He also cited another case for the principle that corporate governance lapses cannot constitute personal fraud liability. While that case exists, it had nothing to do with directors' liability and instead it was related to some other act. Six other cited judgments were simply non existent. The reply also argued that the SEBI Act distinguishes between Category A, which is fraudulent, and Category B, which is administrative violations. So Savale said that since these were corporate governance lapses, these offenses should be Category B rather than A. But no such distinction exists in Indian capital markets law. SEBI observed that the AI tool appeared to have confused the current SEBI Act with the proposed Securities Markets Code bill. And some jokes write themselves. Here's a company involved in data centers that used AI to build up its case and hilariously failed at it. Meanwhile, the non AI defenses were also dispatched quickly. Sabale argued the proceedings violated his right to a hearing, but he was given a hearing which his representative attended. The representative told the panel he was very tired and declined to make oral arguments because he'd been drafting Sabale's reply late into the previous night. But that being said, none of this is the same as the government denying you or your right to be heard. Now, Savale personally was undergoing bankruptcy proceedings as per the IBC. He owed a lot of money. And as per Section 96 of the IBC, he argued there should be a moratorium on all proceedings. But that section only applies to debt recovery, not regulatory penalties. And SEBI's actions fall outside that. As for the Goa data center's electricity consumption, Sabale argued that going from 6 units to 2,450 units is business as usual for a data center trying to scale up. But then, if the data center was commissioned in December 2022, why was it not operational for a whole year? Why did this bump only occur when regulators started looking in? Additionally, Sabale also tried to pass off the office space in Goa as proof the data center exists, which SEBI didn't buy. So Sabale has been barred from the securities market for 7 years and ordered to disgorge the rupees 129 crore. Varanium has been directed to return rupees 62.5 crore in diverted proceeds with 12% interest. And on top of this, the total penalties across all 11 notices come to about rupees 33 crore. Now, the Varanium order doesn't exist in isolation. First Overseas Capital, which is the merchant banker that managed Varanium's IPO, was supposed to be the gatekeeper that verifies the issuer's claims before public money comes in. Clearly, their due diligence was not enough. In fact, this isn't the first fiasco they've been a part of. In January, SEBI found that FOCL had facilitated the siphoning of 54% of another SME company's IPO proceeds. So, in sum, SEBI gave FOCL a 2-year market ban. And BM Traders, the conduit through which IPO money and rupees 119 crore from Sabale's personal account flowed, got a 4-year ban and a rupees 10 crore penalty. And Ethos Capital, the advisory firm that helped prepare Varanium's IPO documents, got a 2-year ban. Some of the directors were also slapped with bans and penalties. Now, SEBI has been tightening the SME IPO framework since late 2024 by raising minimum application sizes, requiring operating profit track records, and so on. Lately, it's been considering overhauling it, and the Varanium order is a case study in why. But this is also a story of the fraud that entails any technology that might show signs of a bubble. The dot-com bubble, the crypto boom, even the first build-out of the railways in the US, all of these famous bubbles have been replete with fraud. There will always be bad actors that try to cash in, and data centers may not be immune to this. So the answer to that has always lay in how swiftly the crackdown on them is. For all the sources mentioned in this video, don't forget to check out our newsletter. The link is in the description. Coming to the second story. India's insurance regulator caps how much an insurer can pay a bank for selling its policies. And there's a good reason for the cap. Without it, insurers would bid up commissions and policyholders would end up funding the bidding war. So the Max Life Axis Bank arrangement is a case study in what happens when a bank wants more than the cap allows. So in 2010, Max New York Life and later Max Life Insurance signed a 10-year agreement making Axis Bank its distributor. Now, Axis was then India's third largest bank and good at selling insurance. But before this, Max Life was doing only about 4% of its new business through banks. Alongside that distribution deal, a second set of transactions began. In December 2011, Max Life issued 7.66 crore shares to Axis Bank at rupees 10 each. Now, this may not have reflected its actual worth. This included an option agreement which let either side force a buyback later at a price linked to the fair market value. Through 2016, Max bought the shares back in 4 tranches at rupees 54.1, rupees 71.9, and rupees 111. On the other side, Axis earned several hundred crore rupees along the way. This is a textbook capital gain that seemingly Axis took in lieu of capped insurance commissions. And again in 2016, Max Financial and its Japanese partner Mitsui Sumitomo transferred 9.57 crore shares to Axis at rupees 10 each and repurchased most of them in multiple tranches between 2018 and 2021. And then in 2020, the relationship was formalized. Max Financial's board approved selling 29% of Max Life to Axis, but that flouted RBI's investment limits. So in early 2021, only approximately 12% of Max's stake changed hands, and it was split between Axis Bank, Axis Capital, and Axis Securities, so that in accordance to RBI's rules, no single entity crossed 10%. Now, selling shares for cheap and buying them back expensive as a way of paying a distributor more than commission rules allow is not merely theory. This was IRDAI's conclusion. The commission cap is IRDAI's rules to enforce, and it found that Max Life and Axis Bank had used the share deals to get around the limits on what an insurer may pay a corporate agent and fined Axis Bank rupees 2 crore and Max Life rupees 3 crore. SEBI itself concluded that this was a regulatory workaround for the insurance commission limits, but that was never in question. What SEBI brought was a different question. So IRDAI regulates insurers but has nothing to say about the rules a publicly listed company has to follow, which is wholly SEBI's territory. See, Max Financial, which is Max Life's listed parent, is writing the checks to buy shares back at rupees 166, so its public shareholders ultimately fund the arrangement. But were they told what was happening? And does dressing up compensation as an investment equal defrauding them? In October 2024, SEBI issued a show cause notice to 25 entities, alleging an approximately rupees 3,900 crore loss to Max Financial and a matching gain for the Axis Group. But this Monday, all charges were dropped on Max Financial, Max Life, which is now Axis Max Life, and all three Axis companies. So, why did that happen? There are two reasons, both of which are about SEBI's case rather than the conduct. So the first is related to disclosure. But the problem is when they said this. Now, most of it predated the LODR regulations of December 2015. But before that, the rulebook was the listing agreement, which required disclosure of material and price sensitive information, but didn't define the material and price thresholds. And SEBI's own later papers acknowledged the ambiguity. Under a rule that vague, a regulator has to argue why a specific item was material at the specific time. But the notices didn't do much beyond pointing at the size of the numbers. The second is related to whether this is fraud or not. Under Indian securities law, fraud requires either that someone was induced into a trade and injured by it, or conduct blatant enough that wrongful intent is evident on its face. But SEBI couldn't prove fraud on any of those terms. There was no manipulation of price or volume and no artificial market. They couldn't truly prove that the parties were secretly colluding. In fact, the SEBI order also noted that the pricing structure had been filed with and approved by the sectoral regulator. But clearly, 10 rupees a share was too cheap. So why isn't that the end of the fraud argument? That's because the shares priced at 10 rupees are the shares of Max Life, which is unlisted, while the listed company is the parent. So SEBI's fraud rules are aimed at manipulation in the public markets, but there is no market in Max Life shares to distort. As a result, all the main allegations fell away, but that being said, the order doesn't say that the pricing was fair. It finds that injury to shareholders was not demonstrated and intent was not evident, but that's not commentary on the valuation. Meanwhile, Max's defense was that if the numbers are to be believed, the partnership worked. Axis came to generate about 45% of Max Life's premiums, while Max Life's embedded value rose from roughly rupees 3,200 crore to over rupees 24,000 crore. And Max Financial shares went from about rupees 175 to a peak of rupees 1,311, and shareholders approved the 2020 sale wholeheartedly. But SEBI refused to treat any of that as a defense. In its own words, a scheme or an arrangement can be highly profitable yet inherently fraudulent. So, a couple of loose threads survive in the order without much examination, and one such thread was around the 2020 sale, where the valuation report was never circulated to shareholders. It was made available for inspection at the registered office during the COVID lockdown, which proxy advisor said left shareholders unable to decide properly. Now, the order records the complaint but doesn't squarely rule on it. Now, 13 of the original 25 notices, who are Max Financial's independent and non executive directors, filed settlement applications which are still being processed. Now, SEBI also added the customary note that nothing prevents it from acting if the transactions are later found to violate securities laws. So far, the commission cap remains in place, but so does the incentive to work around it. Now, coming to the tidbits. 1. The government has approved a Rs 5,070 crore support scheme targeting 5 gigawatt of floating solar capacity with energy storage across reservoirs and other water bodies. While the model avoids land constraints, developers face higher costs, technical risks, and concerns around aquatic ecosystems. 2. The United States has sanctioned 4 Indian firms as part of Operation Economic Outcast to curb illicit petroleum trade linked to Iran. The move highlights increasing geopolitical scrutiny and regulatory pressure on Indian entities navigating trade with heavily sanctioned regimes. 3. PepsiCo bottler Varun Beverages is setting up a wholly owned subsidiary focused on ready to drink alcoholic beverages, appointing former Diageo executive Prathamesh Mishra to lead it. The move marks a major strategic expansion beyond its core soft drinks and packaged water operations. 4. Tamil Nadu has dropped plans for a second Chennai airport at Parandur following strong opposition from farmers over the impact on agricultural land. 5. Indian Railways is preparing new public private partnership frameworks, including a development partner model and hybrid annuity model, to attract private capital. The broader Rs 2.62 trillion pipeline spans new rails, station redevelopment, freight infrastructure, and other railway assets. 6. Fashion retailers including H&M and Mango are scaling back larger size assortments as consumer demand patterns shift alongside the rise of GLP-1 weight loss drugs. While brands are adjusting inventory, analysts continue to debate the exact casual impact of the medications on retail sizing choices. That's all the news I have for you. Thank you so much for watching and see you in the next one. Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.